Your advisor is recommending moving money from the bank and buying an annuity to save you money in taxes by deferring taxes. This could be a very costly mistake unless you understand all of the pieces to this puzzle. By the way, before I cover this, if you want to schedule a 15-minute strategy call to discuss this and more, click the link below and take full advantage of that. So, buying an annuity with non-IRA money can defer taxes. That is a clear advantage because any interest you earn on it, you will not have to report on your income taxes. Until when? And when you do pull money out, you're going to have to pay ordinary income tax. I just recently saw a couple who took money from their bank, put it into the annuity, and they said, look, we don't need the money. We're just going to let it grow and grow and grow. If they don't spend the money, what's going to happen is when they die, their kids are going to pay at a higher rate. So let me give you an example of this. Let's take $200,000 investments, one placed into an annuity, the other placed into a brokerage account. And 10 years pass. The annuity, let's just say for easy math, it's worth $140,000. The brokerage account, which is more aggressive, should have earned more. So let's just say it's worth $190,000. And on both scenarios, we're going to give both cases the same exact situation. Both scenarios, they passed away. The kids would inherit the $140,000. They would owe taxes on $40,000. You guessed it right. At ordinary income taxes. Now, on the brokerage account, they would collect the $190,000. How much taxes would they have to pay? If you said zero, you're right. Well, now, why is that? Because it gets a full step up in base. Now, let's just say they wanted income. The couple that invested the money said, look, we need to withdraw money for whatever we need. And they pulled $30,000 from the annuity. They would have to pay tax on the $30,000 because it's interest that comes out first, and they would pay it at ordinary income tax. In the brokerage account, they could control what they sell to mitigate taxes. There's called direct indexing with tax loss harvesting, which many cases we could have kept the taxes very low. And even if they sold it with gain, it would be subject to capital gains taxes, which are taxed much lower than ordinary income tax. Now, do you think that insurance agent thought through this process for this couple? No. And ultimately, who paid the price? This is where an informed consumer is going to make better decisions than the uninformed. And so that's what we are big about, educating clients and people who are families who are approaching retirement to guide them to avoid these common mistakes that we see. Click the link below, schedule your 15-minute strategy call, and we can talk about this and more. I look forward to seeing you on the next video.